A few years ago, traders could settle their stock F&O contracts on cash basis only. However, all of that changed when SEBI released a circular in October 2019, making physical settlement mandatory for all stock F&O contracts.
Wait, what is physical settlement?
Say you've entered a contract in the F&O segment in which you, the buyer, are paying money to the seller in exchange for a stock of a certain company. Now, if this contract remains open until the expiration date, physical delivery will occur and your account will be credited or debited with the shares or funds depending on your open position. This is known as physical settlement. On this day, both the buyer and seller have to fulfill their obligation towards each other.
Cool explanation. But let's say I've bought a stock futures contract. How do I physically settle it?
Good question. Let's understand how stock future contracts are physically settled through an example. So, let's assume you've bought a futures contract and you've chosen physical delivery. In this situation, to take physical delivery of shares, you would have to pay the cash equivalent to the settlement price. Let's have a look at an example to understand it better. Say you've bought 100 shares of XYZ Limited futures at Rs 5,000. This makes your contract value Rs 5 lakh, out of which you are required to keep an initial margin of Rs 1 lakh to create an open position. Now, when you go for physical settlement, the cash equivalent needs to be bought in along with the initially deposited margin amount to take delivery of 100 shares of XYZ Limited. However, when you sell the futures contract, you need to ensure that you have sufficient number of free shares available in your demat account. Anyway, that's enough theory. Let's look at this a little bit more practically. For example, let's say you've bought one lot of futures of TCS with expiry of 31st October on 21st of October. And let's say that the spot price by the end of the day was Rs 4,000. So your total contract value would be 7 lakhs. This means that you would have to pay an initial margin of Rs 1,40,000 to make the trade. In a futures contract, the margin is settled on a mark-to-market basis. Meaning, if the spot price rose to Rs 4,100 by end of the day, your profits would be based on the increase in the amount multiplied by the lot size. To get delivery of 175 shares on the day of expiry, you must have the amount equivalent to the closing price of expiry day into the open position quantity. So, let's assume the TCS closes at Rs 4,200 on the expiry day. However, if you do not opt for physical delivery, your position will be squared off by the end of the day. On the day of expiry, you have exactly two options. Option number 1 is the rollover of your position from current month to the next month futures. The second option is to square off your open position in the near month contract before expiry or opt for physical delivery according to your position. Depending on the position you had taken in the contract, your shares or funds will be debited or credited to your account the next day, that is T+1 day. If you have not opted for physical delivery, the blocked margin will be released by end of the day. Now, before we end, here are a few things to remember. 1. Value of physical delivery is always the closing price of expiry into open position quantity. 2. If you have hedge trades, it is counted as an individual position, so the required margin of free demat holding will be calculated accordingly. Depending on the direction of the trade, they will be netted off if both legs are ITM. 3. You can opt for physical delivery from Friday to Thursday till cutoff time. And there you have it, folks, a quick walkthrough of how physical settlements work in stock futures. To know more about ICICI Direct's process of physical settlement of futures and options, click on the link in the description. And if you found this video helpful, give it a like and share it with others. Don't forget to subscribe to the ICICI Direct YouTube channel. Happy investing.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.